Welcome to this session on portfolio management. I am KS Pavitra. Today we will see introduction to portfolio management and measure of risk and return. Before we start portfolio management, let's understand what is portfolio. Portfolio is like a collection of securities or investment such as equity, debt, or government securities, mutual funds, or investment in gold, etc. So each type of securities will have their own risk and return. Portfolio refers to the total holdings of investment of an individual or institution. An investor's portfolio comprises of the securities. First, we need to understand the reason behind portfolio. Let's say there are two stocks, stock A and B. So both the stocks are risky, but the nature of stock is in such a way that the combined stock of A and B put together, this actually minimizes the risk. Like if the value of stock A increases and the value of stock B decreases or vice versa, which will help the investors to minimize the risk so that we can put several other asset classes like bonds, debentures, money markets in the portfolio. This will help them to maximize the return and minimize the risk. That's the main aim of portfolio. Now we will see what is portfolio management. So portfolio management is an art for selecting the right investment plan of the investors as well as the institution with the aim to maximize the return and minimize the risk. So it is like a process in creation of that investment plan. So the key factor which will influence the portfolio management are asset allocation, portfolio construction, diversification, portfolio evaluation, and portfolio revision. So we will see in detail. Phases of portfolio management. They are security analysis, portfolio analysis, portfolio selection, portfolio revision, portfolio evaluation. So the first one is security analysis. So this is the first phase in portfolio management. So in this phase, we have to assess whether we have to hold or buy or sell the securities. Like if the worth of the shares is undervalued, then we have to buy that particular share. Or if the worth of the share is overvalued, then we have to sold out that particular share. So it will be based on the fundamentals of the particular company or the investors. So the risk and return of each security will be examined by the investors. So the next one is portfolio analysis. So it is like a process of reviewing what we have done already. So we have set up a portfolio. So we have to review that portfolio. So it should be done at a regular intervals so that it will help the investors to make a efficient portfolio because the market conditions will keep on changing. So we have to make changes in the portfolio according to the changes in the market condition. So the next one is portfolio selection. So portfolio selection will be based on the previous thing, that is portfolio analysis. So this is aims to choose the efficient portfolio from the portfolio analysis. So this will help the investors to choose the correct portfolio for their company or an individual also. So it will helps to choose a portfolio that will maximizes the return for a given level of risk. So the next one is portfolio revision. It's like a readjustment of portfolio. Like some of the securities held in the portfolio may be sold while new securities may be purchased. It's because of we already seen there may be a change in the marketing condition or company's performance or financial market or even in the economy there will be a changes. So we have to make change in the portfolio according to the new environment. So we have to take time, then we have to revise the portfolio. At the time of selection, the environment may be different. So we have to change the portfolio according to the new environment. The next one is portfolio evaluation. So this is the last phase of portfolio management. In this phase, we have to assess whether the portfolio or the securities is performing good or not. So how we will evaluate? So it will be done by comparing the portfolio performance with the market performance. If the portfolio is performing well, it will give a maximum return so that it indicates the efficient choice of securities. If the portfolio is not performing well, it will not give a maximum return. It will lead to a risk. So the next one, who will perform this portfolio management service? Yes, portfolio managers. So portfolio managers offers portfolio management service, like they will understand the client financial position and the aim, and they will design the investment plan according to the client's need. First, they will analyze various investment opportunities which are available in the market, and then they will invest the client fund according to the objectives, that is, the aim of the client. So, first, the main function of portfolio manager is to identify the needs of client. So, first, they have to identify the investment objective of the client. That's the client objective is needed, then only we can make the investment plan according to his need, and the capacity of bearing the risk is very important. Then only we can make a investment plan for a particular client or an institution. So there are two types of portfolio manager: discretionary portfolio manager and non-discretionary portfolio manager. Discretionary portfolio manager is like he can work independently and individually. Totally, he is independent. Whatever his skill, his knowledge, and his judgment can be shown in the investment plan of a client. So he can make the changes in the portfolio according to the environment, according to his knowledge. But in non-discretionary portfolio management, he is dependent on his client. He cannot act on his own. He can act only as per the direction of his client. Whatever the client saying, he has to do. That's the job of non-discretionary portfolio manager. But discretionary portfolio manager, he can work independently. So he can use his own skills, own knowledge, so that it maybe helps them to work efficiently. So the next one, roles and responsibilities of portfolio manager. So the first one is client profiling. So the main role of a portfolio manager is to create a detailed profile of the client, like say the age of the client or the family members, occupation of the client, so that it will help them to understand the needs of the client clearly. So the portfolio manager has to understand the client in depth by getting the profile of the client. So the next one is updated knowledge of market conditions. So portfolio managers must have in-depth knowledge of the market condition and updated knowledge of trend in economic outlook so that he can make an efficient portfolio. Like if he doesn't have that knowledge, there will be a gap between the expected portfolio and realized portfolio. So he must update his knowledge regularly so that the investor's fund will be safe. The next thing is client relationship. So portfolio manager have to maintain a regular contact with his customers or investors because the investors have to keep them informed about the portfolio performance, how the portfolio is performing, how much return he is getting, and how much risk that security will have. So he must be keep on informed them about the securities. So the next one is reporting. So as already we discussed, the portfolio manager has to keep a contact with the clients. So he has to keep on reporting them about the asset quality, uh, industry and market analysis, and also the asset allocation proportion of assets in the portfolio should be informed to the particular investors or the client at a regular interval so that both will have a coordination in allocating the assets. So the next one is risk management. So it is an important responsibility of an portfolio manager because the entire risk will not be eliminated, but it can be reduced in such a way or it can be shifted to the other portfolios. So for this, the portfolio manager should focus on diversification. So diversification is nothing but we have to spread out the securities among the asset classes. Like if we have 100 percentage, we can give 80 percentage to government securities and 20 percentage to mutual funds. So this will helps the investors to reduce the risk so that the return will be moderate. So the next one is asset allocation. So the portfolio manager is responsible for asset allocation. So the investors funds has to be allocated according to the needs of the client. Like asset allocation is like a diversification. We have to distribute the fund among different asset classes. So we have seen already the different asset classes like bonds, debentures, government securities, mutual funds, equity, preference. So these and all called as asset classes. So we have to distribute the fund of the investors with the asset classes so it will helps them to reduce the risk. That's the main aim of portfolio. Now we will see how to measure risk and return. So as we know, for the efficient portfolio, the security return should be maximum and risk should be minimum. So for this, we need to measure the risk and return. For measuring the statistical risk and return, there are many statistical measure, but widely used thing is variance and standard deviation. Because standard deviation and variance they consider because they are very absolute and it is recognized risk measure and it has been used in most of the theoretical asset pricing models. So the variance is denoted by theta square and the standard deviation is denoted by theta. So standard deviation measures the total risk of securities. So when the standard deviation is highly fluctuation with high standard deviation, then the security is said to be risky. When the standard deviation with low fluctuation and low standard deviation, then the security is said to be less risky. So less risky securities have to be preferred more because some of the investors may not have the capacity to bear the risk. So it's better to choose the less risky securities always. So now we will see how to calculate risk and return of a single security. So this is example of a rate of return on equity share of Infinity Limited for the past 7 years are given below. So they have given 7 years detail and the rate of return. Calculate the average return, standard deviation, and variance. So they have asked to calculate the variance and standard deviation. So the formula for variance and standard deviation. So variance is already seen, denoted by theta square is equal to summation r minus r bar the whole square divided by n. Then the standard deviation is denoted by theta, which is nothing but a square root of variance. Standard deviation is nothing but the square root of variance. So now we will see the solution. So the first step, we have to calculate average return. So why we need to calculate the average return? In the variance formula, when you see the variance formula, it is R minus R bar. So R bar is nothing but average return. So we have return in the question itself. We need R bar. So first you have to calculate average return. So average return is calculated by adding up all the return divided by number of times. So 10 plus 16 minus 8 plus 18 plus 26 plus 32 minus 10 divided by 7, that is number of times, that is 7, which is equal to 84 by 7. So if we divide it, R bar is equal to 12. So after finding R bar, in the formula we need R minus R bar, the whole square. So first we need to find out R minus R bar. For that we are opening a table. So we are opening a table. In the first column, year. In the second column, you will be writing all the returns. In the third column, you'll be showing R minus R bar. In the fourth column, you'll be showing R minus R bar the whole square. So first we have to calculate R minus R bar. So already we have find out the R bar, that is 12. So from the return given in the question, we have to minus the R bar. So the first one, 10 minus 12, which is equal to minus 2. So the second one, for the second year, 16 minus 12, which is equal to 4. For the third year, minus 8 minus 12, which is equal to minus 20. For the fourth year, 18 minus 12, which is equal to 6. For the fifth year, 26 minus 12, which is equal to 14. For the sixth year, 20. For the last year, minus 10 is the return, minus 22. In the variance formula, we need R minus R bar the whole square. So now 4 square, 16, 20 square, 400, 6 square, 36, 14 square, 196, 20 square, 400, minus 22 square, 484. So we have to add all these. You will be getting. So now we can substitute in formula. So the variance formula is theta square equal to summation R minus R bar the whole square divided by n. So we have calculated summation r minus r bar the whole square, which is equal to 1536. So divided by n is number of years. So you will be getting 219.43. So now you can able to find out the standard deviation. Standard deviation is denoted by theta, so which is equal to square root of theta square, that is nothing but square root of variance. So square root of 219.43, you will be getting 14.81. So your standard deviation is 14.81. So next we will see how to calculate the return for a single security. So this is an example. 1 year ago, the stock price for the security A was rupees 10 per share. The stock is currently trading at rupees 9.50 per share, and the shareholder just received rupees 1 dividend. What return was earned over the past year? So the formula for return is R equal to dt, that is income received, p power t minus p power t minus 1, that is change in the market price, that is initial price, the difference between the initial price and the current market price, divided by p power t minus 1, which is the initial price of the particular stock. So now we will able to substitute in the formula. So R is equal to D1 is 1, and the difference between the initial market price and the current market price is 9.05 minus 10 divided by the initial market price, that is the starting price of the particular stock is 10. So you will be getting 0.05 or 5%. So this is how you will be calculating the return for a single security. So today we have seen what is portfolio, portfolio management, phases of portfolio management, measures of risk and return, and the problems relating to risk and return. How we have to calculate a return for a single security and risk of a single security. Thank you.